The Carbon Reduction Commitment Energy Efficiency Scheme was originally introduced by the government as a revenue-neutral scheme. There was a recycling system under which money that was paid to the government would actually be recycled to businesses involved in the process. So if you are a canny business and you actually introduced appropriate energy efficiency measures, you could make a profit out of the scheme. Unfortunately, the government pulled the rug from under business in the CSR and removed the profit-raising element for businesses. This means that the money flowing from the CRC is now just going to go directly to the government. At the same time, the government announced a review of the CRC that will lead to a simplification of the process. Anyone involved in the CRC will realise this is a very sensible idea. However, the downside of the review is that there is a state of flux and there will be a transitional phase in which the rules of the scheme will not actually be clear. In this vodcast, we're setting out what the current position is, what the changes are that are being suggested, and what strategies your business can adopt to cope with the CRC. The announcement in the spending review was relatively simple. The government is going to retain all of the money raised from the CRC. This contrasts with the climate change levy, where there was a cut in national insurance that actually made up for businesses the amount that we're going to have to pay in that levy. So the net effect is there's going to be a raise in the energy costs for businesses of between 6 to 7% per year. The only upside for business is that this has been delayed, and the first time you're going to have to buy allowances is going to be 2012 rather than 2011 under the original scheme. The proposed delays mean that the timetable essentially will move back by a year. So the first phase of the CRC will actually extend now out to 2014. The other key changes are that in terms of reputation, there will still be a league table that actually set out how all of the companies compare in terms of the steps they are taking and the measures they are taking to reduce their carbon emissions. That table was going to be used for actually setting out the recycling element to businesses. That will no longer exist, so the only upside now is reputational for companies. The only changes we made in the consultation actually relate to the timing of the implementation of the scheme and when people have to comply. In terms of the price of carbon, that is remaining at £12 per tonne, and the government has indicated it doesn't have any plans to actually raise or change the price of carbon under the CRC scheme. Now, the Climate Change Committee has suggested that the cap and trade element of the CRC is dropped. So this was the idea where the government's actually going to set a cap on emissions by each company and provide a relevant amount of allowances based on that cap. The Climate Change Committee has recommended moving away from this because of difficulties about setting what the level of an appropriate cap would be. This means the scheme will work on the basis that you can carry on buying allowances at the set price going forward, and it removes the market element and possibly the trading element away from the CRC scheme. Now, in terms of actually simplifying the scheme, the government is setting out a review process, and the issue with the process is that it's going to take some time and that it actually causes uncertainty. These include how the mechanism is going to work for the sale of allowances in 2012, which is the first time that you have to buy allowances as a business. You'll be buying allowances for the 2011 year as well at that point in time. It's not clear whether you have to buy both sets of allowances, i.e. for 2011 and 2012 in the same period, or whether you can actually defer the allowances for 2012 until the end of that period. Then there's the issue relating to the trading of those allowances. The question is whether the Climate Change Committee's recommendations are going to be implemented, i.e. whether there's going to be any trading at all. There's a further question about trading as to whether the tax treatment of that is going to be favourable or negative to businesses, as the tax treatment at the moment is entirely unclear.
An organisation's CRC strategy is going to have to address the record-keeping obligations which are already in force. As part of that, organisations are going to have to work out how they're going to gather the information from their various sites and how monitoring and reporting of that information is going to be handled. One of the complexities of the CRC scheme, even in its modified form, is that various obligations arise throughout the CRC cycle, so that at any point in the year, organisations are gathering information, reporting and dealing with the financial implications of the scheme. To prepare for a possible audit, organisations are going to have to maintain appropriate records, including evidence packs. In terms of the finance within the strategy, organisations have a number of options. They can simply accept the imposition of the CRC tax, or they can seek to introduce energy efficiency measures in order to reduce their exposure. They could look to passing some of those costs on in terms of relationships with third parties, including the landlord and tenant relationship. Finally, organisations are going to have to think about how they are actually going to fund the allowances that they're going to buy and how this will be incorporated into internal budgetary processes. In terms of the landlord and tenant relationship, landlords will want to think about whether they can pass on some or all of the costs of participating in the CRC to their tenants. This may or may not be possible through existing lease provisions, depending on whether the CRC is considered a tax and depending on what capacity there is within the existing relationship to recover such outgoings incurred on the part of the landlord. Where a landlord is a participant for CRC, the tenants may object to the principle of having to meet the landlord's obligations through a levy on their holding of the property, or alternatively, they may object to the basis on which any calculation is made. If the CRC is now a tax, then this is likely to have an impact on investment values, on rental values, and on the process of rent review. It may be difficult for landlords to vary the terms of an existing lease, particularly as tenants become more sophisticated, more aware of the CRC, and wary of any attempts to pass on these costs to them. Your CRC strategy should include a checklist for M&A transactions, with due diligence inquiries and warranties. There may also be a requirement to notify the Environment Agency post-completion and update the baseline data. Companies participating in the CRC as a group face particular challenges. Relevant data needs to be gathered from the group companies so that it can be reported by the primary member for annual and footprint reports. The group will need to consider the financial aspect of CRC participation, whether the allowances are going to be purchased centrally or whether funds are going to be transferred intra-group, and when and how this is to be achieved. Finally, on the question of liability, which is joint and several, the primary member will need to consider how it is going to ensure compliance throughout the group, particularly in circumstances where one member of the group fails to meet its obligations under the CRC, where the Environment Agency has indicated that its principal focus of enforcement will be the primary member. It goes without saying that managing these issues will be much easier where there are specific defined intra-group procedures for the reporting of energy use, for the purchase of the allowances and the intra-group transfer of funds. What these arrangements will look like in practice will depend very much on the complexity and size of the group concerned. As part of a strategy, companies may wish to consider whether they can take advantage of any other government-backed schemes intended to mitigate the effects of climate change. These might include climate change agreements, FITs, ROCs, and the renewable heat incentive, most of which came through the recent spending review relatively unscathed.
While the CRC scheme is still in a state of change, there are three main points you need to bear in mind. The scheme does still apply, and you will need to comply with the requirements through this transitionary phase. The scheme is going to be introduced in 2012, and the impact of that means there's going to be a financial impact on your business from the end of that year. You need to start preparing for that change now. This could include considering the energy efficiency measures that your business could take, or alternatively, whether you could pass those costs on to a third party, such as a tenant. The final thing you need to be bearing in mind is to keep yourself updated and abreast of the developments in the CRC scheme, so that once the final form of the scheme is clear, you can adopt an appropriate strategy to deal with this scheme.